All right. Welcome, everyone. This is Tax Tuesday on Tuesday, April 22nd, 2025. My name is Amanda Winalda. I'm a tax attorney at Anderson Business Advisors, and this is
Elliot Thomas, manager of tax advisors here.
All right. And what do we got for these guys today?
Got a bunch of questions.
We do have a bunch of questions. So let's first go over the rules, because when you're talking about tax, it's all about the rules. So in this webinar, in this Tax Tuesday, you can use the live Q&A feature. So chat is if you're having any sort of technical difficulties. You could chat with our team on the side. But if you have a tax question that you want to ask, could be related to something we're talking about. Oftentimes it's not. Just come on in, ask whatever you want. You're going to use that live Q&A feature. We've got a whole team in the background who's going to be answering things for you. Who do we got today?
We got Arash, we got Dutch George, Jared, Jeffrey, Marie, Rachel, Ross, and did we get down there? And Troy.
And Troy's going to be we're live on YouTube, so he's going to be answering questions via the YouTube channel as well. All tax professionals, CPAs, attorneys, people who do taxes, people who talk about taxes, dream about taxes like us.
All the good stuff, the fun people.
Yeah. Don't let them call you nerds, guys. Don't let them do that to you. If we don't hit a question, or if you have a more complicated question, you want us to feature your question here on Tax Tuesday, email in to taxtuesday@andersonadvisors.com. Elliot here, he reads every single one, and he picks them out. So if you don't like the ones he's chosen, you can also send that feedback.
Yep.
I'm just kidding.
We get those too.
Don't bully Elliot. If you need a detailed response, if you want us to run some analysis for you, do a little tax planning, you can of course become an Anderson client or a Platinum client. Platinum is a membership program that we have where you have access to our tax and our attorney team for a low monthly fee rather than an hourly rate. How much did you, when private practice, what was the most you charged clients?
It was a long time ago, but it was, I suppose.
That baby face, don't let him lie to you. It wasn't that long ago.
It was probably about $400 or $500, I think.
Yeah, $450, $500.
Yeah, that ballpark.
Yeah, we're not going to do that to you. We're democratizing tax and legal knowledge. So Platinum member, unlimited access to our team. This whole thing is supposed to be fast, fun, educational. We want to educate you. We love working with educated people. It makes our job easier, that's for sure.
Absolutely.
Mm-hmm. Where's everyone joining us from? Go ahead and put that into the chat. Unlike questions, let's use the chat, see where everyone's joining us from. Palmer, Arkansas. Draper, Utah. We have an office out in Draper, Utah. Come visit us. Most of our attorney team's there. San Diego, a lot of O's. I'm originally from California, just north of San Diego, so Riverside County. Chicago. O'Brien, Florida. Ohio. Vegas, baby. That's Suzanne.
Winchester.
We're located in our Anderson studios off of Rainbow Boulevard in Las Vegas.
Famous suite number 210, is that what we're in?
Yeah, the infamous.
More than just famous.
All right, Denver, Chicago, a couple people from Chicago, Princeton, New Jersey. My father-in-law went to Princeton. Nice. If you know anyone who's been to Princeton, you would definitely know that they went to Princeton, because they'll tell you. Fargo, North Dakota, Irvine, familiar. All right, so we're gonna get in, we're gonna review, just let you know what the plan is. We're gonna go over the questions that we're gonna hit on today, and then we'll actually answer them. So first up, I would like to sell my stocks and use the money to help purchase a rental property. Is there a strategy to minimize or avoid paying taxes on capital gains, or any other tax-saving advice? Yes, there is. Stay tuned for more. Elliot, what do we have up after that?
Would a rental, not an LLC, also be reported under the management corporation or a 1040?
Right, that's a little asset protection, a little tax. We do both here, so we're going to be able to give you that. What would the tax implication be when a spouse passes and the surviving spouse inherits a 401k? That was one of the more complicated ones when we were reviewing these. Yeah.
Yep. What would be the tax consequences concerning W-2 income, depreciation, etc., of purchasing a rental property, using it as a short-term rental with material participation in the tax year that it was purchased, then selling it the following tax year?
That sounds tiring.
Yes, it does.
Buy something, sell it, turn around, sell it. But
A lot of work.
it could work out for you. If you're willing to do the work, you can save a lot on taxes sometimes. What are the tax implications if I move back into my rental and use it as my primary residence? I'm not planning on selling anytime soon, which is a key fact that's going to change some things around a little.
What is a reasonable salary range we should set for ourselves to remain compliant but still maximize our S corporation tax savings?
Yep, that reasonable wage requirement. If a person is a W-2 wage earner and wants to start real estate as a side job, what needs to be true when picking real estate options to maximize asset depreciation to help offset my W-2 taxes owed? A lot of these questions are gonna be a little bit overlapping, a lot of things applying to multiple answers here.
If I experienced a loss from a flood that was declared a natural disaster in 2024, how do I take that credit on my taxes?
Oh, which flood was that? I don't know.
Yeah, I knew of fires, but I didn't know of a flood myself.
The hurricanes.
Yes.
There's a lot of natural disaster stuff going on, so this is a common question. How do you depreciate remodel costs for an income property, so a rental property? You purchased the property, for example, 10 years ago for $100K and began depreciating it. This year, you put $30K into a remodel that included floors, paint, kitchen cabinets, and appliances. So a couple of depreciation questions we've got going. This is our final one.
This is a biggie.
It's a long one. You can do it, Elliot. You can do it.
I'm interested in using the 280A/Augusta Rule rental of my home for an upcoming seminar that I'll be attending online. Am I allowed to use this strategy since I'm the only one attending? We get this question quite a bit. Also, I reviewed the document that Anderson put together for the 280A. It mentions getting 3 quotes. If I call a hotel and ask for a conference room quote for one person, I imagine I won't be taken seriously. Do you just request a small conference room for less than 5 or for 5 people or less? Any advice on getting the quotes?
Yeah, we will be able to do that, cover that. So if you're here on YouTube, you're on Toby Mathis's channel. He is one of our founding fathers, founding partners. He's a tax attorney. He's TaxWise Toby on Instagram and the TikTok. He's on the TikTok. Cooler than us, I guess.
He's way cool.
He's got some followers. We've also got Clint Coons is who our other founding partner. Clint focuses more on asset protection. Toby focuses more on tax, but Anderson is a unique place where we do both under one roof. So if you've ever spoken to your attorney and then they send you over to your tax professional and then your tax professional is telling you, well, that's a legal question, go ask your attorney. And you're kind of stuck in the middle going, well, I don't speak attorney or CPA, how am I supposed to translate? Around here, you don't have to, because we speak both. So click, subscribe, smash that.
Bilingual.
Yeah, we are bilingual. I don't speak any other languages, do you? No. We have people who speak a lot of languages. We had somebody who spoke 7 languages.
It wasn't me.
Yeah, it wasn't me either. But subscribe to those YouTube channels. You'll get a notification anytime something new pops up. We also offer our tax and asset protection workshops. We've got 2 upcoming one-day seminars, Saturday, April 26th and Saturday, May 3rd. It's morning is asset protection, afternoon is tax. It's a full day, so eat your protein bars and bring some snacks. I cover tax on those frequently. I think I will be, I'm gonna do the May 10th one, so not listed here. We also have our live event, so if you just wanna come see us, you can. Come out to Las Vegas, June 26th through 28th. It's 3 full days of everything you need to know in terms of protecting your wealth, launching your business to the next level, estate planning, tax planning. We've got everything. Plus, it's in Vegas, so why not take a tax-deductible business trip out here, right?
Sounds good to me.
Here is the QR code if you want to join us live for that June live event. Only $99. Oh, wow.
Yeah.
That's inexpensive. All of that for free. Well, Toby Mathis does say we're an education company first. We do a lot of free seminars. We do a lot of online training. I mean,
that's why we're here today.
That is. Thank you, Elliot. That is why we're here today. All right. I would like to sell my stocks and use the money to help purchase a rental property. Is there a strategy to minimize or avoid paying taxes on capital gains or any other tax-saving advice. So first of all, when you do sell stocks, those are capital assets, you'll pay capital gains. The rates are 0, 15, 20% based on your income. So most of the time, if you're going to liquidate enough stocks to buy a rental property, you're probably looking at that 20% tax rate.
That's often the case. Now, there is that unique situation if you held the stock less than a year, that would be at ordinary rates, but we typically don't see it. So we'll go with the kind of more common, that's going to be a long term where you do get those more favorable rates that Amanda's talking about. And ways to kind of knock that down. If we had any losses out there, you have, let's say stock A, you sold at a profit. Now we got stock B over here that you'd listen to Elliot on that pick and it's not doing so well. You may want to go ahead and sell that, create a loss. And that's going to marry up, it's going to match with your capital gain there. And so that's one, we call that loss harvesting. Excellent way to start knocking down those capital gains. We mentioned here, though, in the call to question, I think something about rental property. So there might be a couple things we can do there. Any ideas?
Yeah, that's for sure. I do think some brokerage online situations, you can kind of opt into loss harvesting and that will automatically do it in the background if you've got a big portfolio. It may not be feasible to individually look at everything, but who knows? So loss harvesting one. Okay, if we're buying a rental property, what can we do with that rental property to generate some losses? I'm thinking real estate professional status, short-term rental loophole.
Yes, and the difference here, short-term rental, again, that is the traditional Airbnb, something of that nature where your average stay is 7 days or less. Puts it in a different category for how we treat things. And in order for it to be a non-passive activity, you just have to materially participate. Lots of different tests for that. The most common, you put in over 100 hours and more than anybody else, or over 500 hours. If we reach that status, and then we do things like a bonus depreciation, cost segregation, couple those together, often you're going to create a loss, and that loss will go against anything on your return, including those capital gains. Fortunately, it will actually hit your other income, your ordinary income first, which is always at a higher bracket. If you wipe through all that with the loss, then it's going to start attacking those capital gains as well. So that can be really effective. That's the short term. But if we had the long term rentals, where I think we're looking at more involved.
Yeah, a little bit. So for real estate professional status, and mind you, both of these, real estate professional and short term rental, call it the loophole, but the short term rental strategy are designed to take what we normally think of as passive income losses, generating those, but you're doing enough work, you're putting enough sweat equity that the IRS says, you know what? We're actually going to call that active. And then by generating those active losses, that reduces your taxable income overall. So it's not directly necessarily offsetting the capital gains from the stock, but it is reducing your total taxable income, which is going to typically result in a net positive for you. So real estate professional status is when you have long-term rentals, so over a year or usually more than a year or a year or more, typical what you think of a lease agreement, and you have to meet certain parameters. Now, if you've got a full-time W-2 job, you most likely will not be able to qualify as a real estate professional because the first test is that you have to spend 50% or more of your personal services in your real estate trader business. So managing your rental properties. If you have a 40-hour-a-week job, you need to spend 41 hours a week managing your rentals, which is quite hard to do.
Yes.
Or you're just doing it really badly. Or you have a very bad investment portfolio if it's taking you that much time to manage just a normal short, long-term rental there. So 50% of your personal services, plus you need to materially participate. Again, Elliot said there's several material participation tests. In this case, we're typically looking at the test that's 500 hours per trader business. So you just have to hit a minimum of 500 hours. You don't have to do more than anyone else. So if you have a property manager, you can even elect to aggregate all of your properties together. So 500 hours is kind of a lot to meet for one property, but if you've got 10, or if you're doing property management through your own company, you can aggregate all that activity and hit that 500 hours, and then the 750 hour minimum for the year. So complicated, but if you meet that, essentially you're putting in enough work in your real estate trader business that the IRS now says, okay, well, that's active income. Well, Not necessarily what we want, but there are things we can do to supercharge our losses.
Yes. One of them being the cost seg. We kind of talked about that earlier. Cost seg, all it does, it takes what would normally be deducted over straight line. Let's say we have a short-term rental that's deducted. It's a business asset. The building's deducted straight line over 39 years, same amount each year. But the cost seg says we're going to break that building into different pieces. Some of it will be 39. It's probably going to be your foundation, kind of your more sturdy parts of the house. But there'll be other things like carpet, flooring, lights, wiring, et cetera, that are going to be 5, 10, 15-year property. We break those down. Those are going to depreciate faster because it's not over 39 years anymore. It's now over 5 or 10 or what have you. Then we can add on what's called bonus depreciation. Anything placed in service that year. Here in 2025, we're looking at 40% bonus depreciation. So we'd look at the total amount spent on that one asset, and we get to add on another 40% deduction immediately. Speeds up a lot of deduction, typically causing a loss. If we're materially participating, as Amanda talked about, that loss will now go offset any income on your return. And kind of a bonus here, not just lowering your ordinary income, it could lower your ordinary income enough that you're in a lower bracket, so now your capital gain's no longer at 20%. It even goes down to maybe 15%. So a lot of good can come out of this.
And the bonus depreciation goes down to 20% next year.
That's right.
It was
right
at
now.
100%.
It was for a long time.
For a while. There's currently a bill in Congress. Hopefully we're going to bring that back up to 100%, in which case this strategy of depreciation is going to, accelerating depreciation is going to supercharge. We're going to see a lot more of this, people doing that.
Yep.
Right. All right. Would a rental property not in an LLC also be reported under the management corp? So let's visually look at what we mean, because if you work with us on the asset protection side, you may already understand what's being asked here. But typically, we're going to have a rental property. Now, normally we're putting that rental property into an LLC for asset protection purposes, but in this instance, it's just owned by an individual. That doesn't actually, whether or not it's in an LLC isn't going to change the answer from a tax perspective.
Correct.
But we're often recommending clients do a property management C Corp. There's a lot of tax advantages to that. And so what we're going to need is a property management agreement. And then the corporation's going to provide property management services to this landlord, finding the tenant, collecting the rent, maybe paying for repairs, finding the plumber, oftentimes even paying the mortgage, because again, it's not a third-party property manager. It's you doing the same things you've always done, just with your C corporation hat on. And you're going to charge a normal rate, 10%, 12% fee back to the corporation.
Typically on gross rents.
On gross rents, yeah. Whatever is standard for the area that you're in. Now, what is being reported on this guy's 1040? And this corp is going to have an 1120. What expenses are going where?
So any of the operational expenses of that rental, and of course all the gross income, are going to report on the 1040. So you'll take, let's say the rent's $1,000 a month, 12 months, you have $12,000 of total gross income reporting on your return, and then all the various expenses from the operations, advertising, lawn care, mortgage interest, depreciation, property taxes, et cetera, all that will be deducted there. And then there'll also be a management fee, because we are paying our C corporation, we'll deduct that out as well. You get down to a net amount, and that's what all goes on the 1040. Kind of easy to get this confused, because if I'm the tenant and this is my landlord and she's working on her C corporation, when I pay Amanda's C corporation, you see all the income go there. My whole rent check goes there, and maybe it's paying some bills. But we got to remember, the C corporation doesn't own the building. It's only providing a service for Amanda. Mm-hmm. And so we're not going to report the income there. The only income it has coming here is that management fee, that 10 to 12% Amanda was talking about. That's where it's going to have its income, and then we're going to do all kinds of things to try and wipe that income out on the C corporation return.
Yeah, so the tenant's paying the C corp the rents and then the property management companies deducting out the expenses it's paid, and then paying over the net rent is going back over to the individual in this case. And what kind of stuff are we doing to get out of the C Corp? What sort of deductions are we taking? It's got the management fee as its income. What are its expenses?
It's certainly we have the accountable plan reimbursements. That could be if Amanda had a home office, administrative office, we call it. There's an amount she can be reimbursed from the corporation for that use. We're going to talk a little bit later about 288 Augusta Rule. She can rent out her home for meetings, the corporate meetings in her house, get paid. You can do up to 14 times a year, tax-free to her. All of these are deductions that gets the C Corporation. Maybe she wants to use the medical reimbursement plan that we put in a C Corp. She could be reimbursed for all those. All those are going to subtract out from that management fee income that we had. And hopefully we just zero that out completely.
Hopefully we zero it out.
Yeah, so we just, whatever that 10, 12%, you just pocketed cash tax-free.
Completely tax-free.
And got a deduction at the same time.
I mean, you can imagine a scenario where your portfolio grows, you have 10, 20, 30 properties collecting a 10% fee. If we don't have enough deductions, we can even set up a solo 401k plan, pay yourself a salary, start deferring some tax on some retirement savings.
And if we had a lot of money, we could even do a DB, a defined benefit plan, which is just kind of your 401k on steroids. It's just putting a ton of money into it right away. So a lot of good options there, very flexible.
For sure. So what's showing up on your 1040 is the rental income and the rental expenses for that property. And then what's showing up on the corporate return is going to be the management fee minus whatever expenses that you have, some of which we listed here, separate. All right.
Perfect.
What would the tax implication be when a spouse passes and the surviving spouse inherits a 401k?
So this can get really into the weeds here, but just on the surface, first of all, a spouse inheriting the 401k can certainly just take what we call the lump sum. Drawbacks to that, it's going to create a lot of income right away, so maybe we want to wedge it out over some time, but that certainly is one option to take the lump sum. Another is that you can basically start taking over the distributions just as the spouse was. If the spouse was already taking distributions, you can just step into their place. Keep kind of those distributions coming out to you. In the case of a 401k, it would be taxable income. Nonetheless, though, it's extra income coming to you from the inheritance. Or you can roll it over into your own plan. Maybe you have your own 401k and you can move over there, and then you wouldn't maybe take any distributions until you're 73, or depending on when you were born. Those rules change, 73, 75. So those are some options that one could do. The lump sum, basically standing in the shoes of the decedent, or 3, rolling over into your own plan. All viable options that we could take advantage of.
And the rules are different if this is a IRA, so make sure it can get complicated. If you're rolling it into your own and you've already started taking distributions or required minimum distributions from your own, you're going to have to recalculate everything because it's a larger amount. You're going to have to take more distributions there.
And just we had talked a little bit about the Roth component here. This wasn't brought up here. Typically, you're going to get the Roth tax-free as well because you inherited something that already had paid tax. Now, there are some special rules there. There's a way to hear about the 5-year rule. You may have to wait 5 years from when the decedent started that Roth plan before you can take out with having some penalties. It really does get a little bit dicier, a little more complicated, so certainly talk to somebody, but just so you're aware, there are those options as well for a Roth. Some things that we can do there.
Taxable income. Right. What would be the tax consequences concerning W-2, depreciation, etc., of purchasing a rental property and using it as a STR, short-term rental with material participation, in the tax year that it was purchased and then selling it the following year? So we did talk about this earlier on in our first question, but STR with material participation, that's going to be our short-term rental loophole for short. And so that's where you're renting out. Average length of stay is 7 days or less, so a true short-term rental. And then the material participation, several tests. The most frequent test that we're going to Meet is 100 hours, but more than anyone else. So you're going to need to put in at least 100 hours, and you're also going to need to do more work than anyone else. This gets a little tricky with a short-term rental if you don't live close by, because you're going to have to account for the cleaners there.
And also, with that, you want to make sure that, well, we've had clients, let's say they live on the West Coast, they have that short-term rental on the East Coast. Courts, the IRS, if they look at that, they're going to be skeptical. How much time, how did you really manage it from afar like that? So kind of along the same lines. And absolutely, you got to track the hours of anybody who is down there. So that can become a little bit difficult. So we like to see that short-term rental nearby, relatively speaking, in the same area. But directly getting into what happens in this situation where we get one in year one, uses a short-term rental, we do that cost segregation with bonus depreciation, get that heavy loss deduction, we got the material participation, so that loss will offset any income on our return, so everything's looking really good. But then what do we do in year two? We're going to go ahead and sell it. Is there any tax, consequence benefit? What happens? Well, when we do that short-term rental, there's some things that we want to, that cost segregation, again, it breaks it into different pieces of depreciable property. Some of it's just the same old building. Again, the foundation's typically the example. That's still going to be 27 and a half or 39 years in the case of a short-term rental. But we have all that carpet, all those lights, electricity, or electric circuits, what have you, and not the electricity itself. But we'll have 5, 10, 15-year property, things like that. That's what we call 1245 property, or tangible or personal real property, versus I'll call it the real estate, which is your 1250. Now, when we do that, we take the depreciation, we're taking all this bonus depreciation in year one, and now we sell. And here we're going to need maybe some example drawing here a little bit. This gets a little bit dicey.
Oh, okay.
So you got a house. There we go. And we're going to break it into 1250 and 1245 property in year one. Now, the 1245, again, is the shorter 5-year, 10, 15, something like that. And we're going to speed that up a little bit here. And let's just say, what do we want to say, maybe $50,000 on that? That's the amount of depreciation we took the first year. Let's say, what do we want to go, 100? Yeah. Okay, 100 there. We originally bought it 300. We're going to not count land here. We're going to exclude that from the equation here just for simplicity. And so our basis when we buy it, 300,000. Amanda's got this rental. She did a cost seg. She took 150. She's going to subtract that from her basis, and that's going to give her adjusted basis, which is another 150. Bad example there, I guess, my fault. So adjusted basis of 150. Now let's say that in year two, she sells it, okay? And we can do this a couple different ways. We could sell, let's say you want to go for 400 on the first one?
Yeah.
Okay, so if she sells at 400 in year two, we're now in year two, we're going to subtract that adjusted basis that she has of 150, and that gives us a profit of what, 250. And if we didn't, think any more about it, we'd probably just call that the capital gains, 250,000. Well, here's the problem, is that we've already kind of gotten a benefit by taking away, eroding from our basis when we took that depreciation, and we can't really double dip. So the government says, we're going to call some of that back in. We're going to make you pay tax on that amount of depreciation you took, okay? Call that depreciation recapture. But the rules start to kind of split here when we're talking about your 1250 or your 1245 property. And when we do that depreciation recapture, it comes off the top of our capital gains. Again, our profit here is 250. So the first 150 is what we're going to have to recapture. 100 of it is 1250 property, the first 100. Mm-hmm. And that is going to be taxed at a maximum 25% when we recapture. And the 1245 is going to have, it's going to be at whatever your ordinary tax bracket rate is. So in year one, if we'd had really high income, Amanda's in the 37% tax bracket, she got a really great deal when she took that $150,000 of deduction from the cost seg and bonus depreciation. Very nice tax bracket break at 37%, the highest bracket out there. Now year two, she's selling it back. Let's just say she's still in that high tax bracket. Well, the most she has to pay on any of that the 1250 is going to be capped at 25%. There's a 12% break or gain there, or delta. She's going to come out ahead by 12%. The 1245 is going to be at her ordinary rate, 37%. So no break there. She's going to break even there. But she still comes out ahead in this overall aspect. Any of the other capital gains, the 250 minus the 150 that we took, so $100 left, 100K left here, that's all going to be at your 15 or 20% tax bracket capital gains rates. So yes, this could still work for us if we took that heavy depreciation this year, turned around and sold it next year. Maybe a bit unconventional, but yes, in this case, Amanda would come out ahead.
Yeah, it really depends what your other income is going to be in that second year. If you're going to have high income, you're in a high tax bracket. Worst case scenario, you're paying 25% on a lot of it.
Exactly right.
You're still going to be saving. But if you're not doing anything, then save a lot.
Yeah, if just a quick add-on to that, what if the next year, you made all your money in that first year? That's why you did the cost seg. That's why she went out and got that short-term rental. And second year, she took a break. Didn't have a whole lot of income. Well, then, her ordinary rate's going to be very low on that 1245, so she's going to come out pretty well there. And her profit, it can't exceed 25%, so it's definitely going to be below that. 37% her tax bracket in the first year minus whatever her ordinary rates are in year two. That's going to be the delta. That's going to be your change. That's going to be her savings on this whole deal.
Is there any type of audit risk for doing this? For doing this short-term rental loophole, we call it a strategy, in 1 year, having that property reported on as a short-term rental, and then the next year having it be gone. Is that raise a red flag for audit purposes?
I think that's the best question asked all day here. It could be, but I don't think the IRS is particularly looking at that. You did properly report it. You ran it as long as it was being rented, actually rented and used. They'd be hard pressed to say that wasn't a business venture. You certainly had it rented, and so and the government, the rules are very, very much supportive of one's right to interact and contract on these type of things. So while it might get their interest, I don't think necessarily you're looking at an audit risk.
For sure. Yeah, they can't make you, IRS can't make you keep a property if you don't want it anymore.
Right, exactly. Sell it.
Yeah. Plus, that latest news, 22,000 IRS employees might be taking the buyout offered by the government. So what do you think that's?
And Toby talked often about them trying to raise 80,000 jobs. They just not only they never met that standard. Now they just lost 22. So
maybe audit rates are going down anyway.
Yeah,
so.
there's a consequence. Everything has a give and take.
That's true.
There's no free meal.
What are the tax implications if I move back into my rental as my primary residence? I'm not planning on selling it anytime soon. So when your primary residence, you get some deductions from your taxes for that. But number one, you're not going to be making any rental income, so no taxable income based off your rental. What are the things that we are still allowed to deduct?
Well, as a primary, you still typically get to deduct the property taxes if we're itemizing on our Schedule A and your mortgage interest. And, darn it, that's kind of where it ends because they really are not big on you deducting your personal expenses. But the mortgage interest on your primary, subject to a few limitations. If you have a loan over $750,000, you're not deducting that interest. And then the property taxes, those type of things would. If you're itemizing against Schedule A, then you'd be able to deduct those as your primary residence. But as Manon pointed out, we're not, you're still having that rental income, you're declaring that. You had a whole host of operational expenses, advertising, management fees, property taxes again, interest, depreciation, all those are gone. Except for the mortgage interest and property taxes.
Most likely, though, at least this year and until the end of next year, you're taking the standard deduction. It's still quite high. The standard deduction, those Tax Cuts and Jobs Act rules from 2018 are going to start phasing out. And so the standard deduction drops to half of what it is now. So you may get a larger deduction by itemizing there. So something to keep in mind. What about repairs, maintenance, capital improvements, how does that change? Because if I've got a rental property and I make a repair, I get to deduct that. That repair is essentially tax-free. That's not the case with your primary residence, unfortunately.
Yeah, it's really not. If it rises to the case of maybe an improvement, well, we can add on to basis, okay? Let's say Amanda, again, buys her primary house here. Oh, excuse me, in this case, it was a rental first, $300,000, then she moves into it, put some repairs in it. Elliot had been renting it out. It's all a mess now. So she puts $75,000 of improvements into it. It's going to raise her basis. So there you're going to, but maybe you're just kind of your standard repair. You're not going to get much of a deduction or even a basis raise if you're personal residence.
Yeah, just got to eat it.
But there's another aspect too here at the end here. I'm not planning on selling anytime soon. That kind of leads me two ways. Number one, we're talking about, well, we might sell it sometime. It's just not right now. And both of those have some significance potentially. There it is, the 121. Amanda's way ahead of it, as always. And the 121, we got an interesting situation here. As you may remember, the 121 rule, the basics are to the last 5 years. You have to own the property and you have to use it as your primary residence. And what is the 121, excuse me? If you meet those criteria of ownership, 2 of the last 5, use of primary residence, 2 of the last 5, and if you're married, filing joint, you can take a $500,000 exclusion against any gain on the sale, $250,000 if you're single, except in the situation that we have here, where you have Amanda first had it as a rental, let's say 5 years, and then she moved into it for 5 years as a primary. The code will say, well, you've held it for 10 years total, but you had 5, what they say, non-conforming years. 5 years as a rental where it wasn't a primary residence. So 121 says that case, 5 divided by 10, that's 50%. It says whenever Amanda finally sells this property, whatever the gain is, let's just say the gain is $1 million. 50% of that, or $500,000, is not eligible for 121. So it's going to cut how much. Well, in that case, she'd sell $500,000, so I guess she'd be okay. Sorry, bad example. If you had $200,000 of gain, $100,000 would not be eligible for 121, but the other 100 would. Mm-hmm. But we have another factor here that they throw in. Ooh, she used it as a rental. They took depreciation as a rental over the years. So Amanda's seen this depreciation when she had a rental. That we have to take into account as well. We have to take that depreciation recapture again, first away from our gain. Then we do the impact on the 121, that's the 50%. Mm-hmm. When we take all that away from the 500,000, then we'll finally find out how much she's is eligible for the 121 exclusion.
So, to summarize, for the years that you've been using it as a rental, you're going to have to recapture depreciation, and this 121 exclusion is reduced.
That's correct.
So that is the impact of doing it. Now, if you are previously in a primary residence, like they're moving out of that primary into the rental, can we use 121 on that old house?
Yeah, let's look at that. Amanda is living in it. Her family's in the house, primary residence right now. Now they move out. Well, remember, we still have to make the 2 of the last 5 years. So as long as she's making that, she's okay because they already qualified. They already had conforming years, 2 of the last 5. They're good to go. Unless she rents it out too long and we step outside of those conforming years and now we don't have 2 of the last 5 years, then we get pulled back into what we're looking at here.
Nice. How often can I do this 121? Every 5 years? Every 2 years?
Every 2 years, typically. Well, unless you sell to a related party, then we may have to wait 5 years. There's some special rules depending on who you sell to and things like that.
There's always special rules around here. Always special rules. Thank you, Elliot. That was quite clear. And thank you for handling that last question while I choked and Matthew had to bring me some water while I die next to you. He just keeps going. That's how serious we are about making sure you get the answers to your questions and the tax savings that we will let our colleagues
we'll just keep going.
choke and die.
The show goes. The show goes on. We're woman down. Keep the show going.
All right. What is a reasonable salary range we should set for ourselves to remain compliant but still maximize S-Corp tax savings? So the question asker knows if you have an S corporation, this applies to a true Inc. that's made an election to be taxed as an S corp, or an LLC, which can also make an election to be taxed as an S corp, there is a reasonable salary requirement. And so what is reasonable is essentially what we're being asked here.
And that is a great question.
And that is a great question. The philosophers of, I'm just kidding. This is a term, almost a term of art in the law. We use the reasonable man standard in a lot of things, from personal injury to tax. And so what is reasonable to one person can be not reasonable to another. So in this specific situation, can we pinpoint it down to just a number? Give me a number, Elliot. I just want a number.
Yeah, well, no, we can't. Because it is an art. There's not much art, okay? There's not a lot of coloring in the tax code, but Amanda's exactly right. This is the closest we're going to get. And it basically just says, what does the reasonable person make doing what you do in the area you're doing it geographically and type of business? That's kind of what you go by. And so you can maybe, suggestions out there, Google, find out what the average person is making doing what you do in that area.
Department of Labor.
Right. They have
has
a lot
some
of data.
reports. Just go onto a job board and type in your job description. It's a little hard to do it this way when you're talking about your own corporation. If it's a closely held family business, or if you're the only person, you're doing all of the jobs. I can't add up the marketing job, the CEO job, the bookkeeping job, the service provider. I can't add all those up. I'd be paid $1 million.
Right.
So how do we do it? Is there another method to figure out what a reasonable salary is?
We use as a rule of thumb, we like to look at the net income. First of all, just to set the standard here, you're not required to do a reasonable wage if your business wasn't profitable. Okay, so that means
that would be unreasonable.
Exactly.
To pay yourself money you don't have.
That would be the unreasonable person, all right, which sometimes the government might be. But nonetheless, here we don't have to do a W-2 wage if we're not profitable. That assumes that we are profitable, okay? So if we had $500,000 gross and we had $400,000 of operational expenses, that nets us at $100,000. So a lot of practitioners out there will say, okay, well, we got $100,000. As a rule of thumb, anywhere from a third to maybe 60% might be what I'll use as a reasonable wage. In this case, about $30,000 to $60,000 might be what I pay myself. But that is not an IRS rule. So
would you say 30 to 60?
30% to 60% is typically a third to 60, somewhere in that range. Mm-hmm.
I think you'll get different percentages
Absolutely.
depending on
No
who you
question.
talk to.
That is very true. And so, 50% is often thrown out there as well. But nonetheless, as you can imagine, the lower you are, 30%. And why are we doing this? Because we're trying to save on employment taxes. But the 30%, you're going to have more to justify with the IRS if you ever got audited. Why was it 30 versus 60? Well, then you try and come out with all the studies that you found from the Department of Labor and whatever to try and defend.
I'm only spending 10 hours a week on this business. Well, you don't get $100,000 for spending 10 hours a week working. Not in this economy.
Right, exactly.
So,
with inflation? No way.
Yeah.
Right?
And why do we want to make our salary lower is because that salary is going to be subject to payroll taxes. 15.3%, half
No
paid
small
by
amount.
your company, half paid by you through withholding typically. This distribution, not subject to payroll taxes.
Exactly.
Potentially coming through. So do you want to save 15.3% on all of it? On 70%? On 40%? We're usually trying to weigh things towards this side.
And if we really want to get into it, it's really beyond the scope of what we could do here. But we have other concepts here. If you have a wage going on of, say, $50,000 you paid yourself, you might have something called a 199A deduction that's dependent on that wage. You could be using things like the 280A corporate meetings or accountable plans. So there's all these things that could impact and factor how much wage you want to pay, how much is going to be distribution, what's going to be left over after all these reimbursements, et cetera. So there you really do need the tax planning. It gets a little more complicated, but this certainly goes beyond just the surface level of understanding the wage.
From a practical standpoint, how do I know what my net income is going to be till the end of the year? How do I pay myself throughout the year?
It's just good planning. You try and forecast as best you can. Obviously, the closer you get to the end, you have a better idea, a better forecast. I highly recommend doing a little bit of this at the beginning of the year, and then we can see where we're at, maybe September, maybe August, something like that, late July. Look how much has changed. What do you anticipate the end of the year?
Yeah, it's a reasonable salary, but there's no requirement to pay yourself every 2 weeks. I mean, most people want to get paid every 2 weeks or bi-monthly, but if it's just you running the show and you're not quite sure, we have lots of clients who pay themselves quarterly, sometimes even wait till the end of the year to figure out this amount, cut themselves one check, and then defer most of it into maybe a retirement plan or a solo 401k plan. So it's not necessarily, you're not having to set up payroll every 2 weeks. You can be paying yourself every quarter and adjusting that every quarter even.
Absolutely. Another great point. Give yourself a happy thing.
Star.
And then play some music over there or something.
No.
Where we got.
I do not like these.
Yeah, maybe that was a bad. All right, that's a wow moment.
I don't like these. These are so goofy. I know Toby loves them, but they're too silly for me. I'm serious.
Oh yeah, well, hardly. If you ever really knew him, no, she's. But anyway, another great point though, because that reasonable wage, you don't have to do it all, evenly throughout the year. That brings a lot of relief to a lot of clients. Hey, because I was really stressing it. You don't need to be doing that, but you do need to make sure you pay it. Have some good tax plans. See where we're at on it.
Yeah. It's really going to depend on where you've got other income coming in, how frequently.
Yep.
All right. Shameless plug. Come see us at our tax and asset protection workshops, our one-day webinars upcoming April 26th and May 3rd. They start at 9 a.m. Pacific, and we go through till about 3:34. We tend to format very similar to this. You can come on, you can ask any kind of questions that you want. We have typically a couple of attorneys and a CPA answering questions in the background. The most I've seen answered in that one day is 1,500 questions. We have excellent health insurance for all of the carpal tunnel that we get around here. And we also have our 3-day live tax and asset protection event. Here's a QR code. You can snap that real quick with your phone. $99 and you get 3 full days. And that's going to be all day. 9 a.m. to usually 5 or 6. We got some great vendors that come out. And people tend to have a good time when they come to Vegas.
Absolutely. Probably too good.
The room's sometimes more full on the first day than it is by the last day.
They slumber in a little later each morning.
Tax deductible business trip. So come on out and see us. Or if you're interested in becoming what?
And I heard it. I think it's at the new Durango. It's a relatively new casino.
Oh, yeah, that. You got to be, if you're not a local to Vegas, maybe you don't know all the new hotels that are coming out, but the Durango's very nice.
Yeah, that's what I've
heard some good things about it. They're not a sponsor, but I'm just kidding. If you do want to get involved with Anderson on the tax or the legal side, you could schedule a free strategy session. This is a 45-minute consult that is geared directly towards you. We got business advisors, senior strategists who's going to listen to your goals, know what your needs are, think about what assets you have, your concerns, and we're going to build a plan, a blueprint essentially for how to address those concerns and save you money moving forward. Free.
Absolutely.
Not even $99. I know. All right.
Figure.
If a person is a W-2 wage earner and wants to start real estate as a side job, what needs to be true when picking real estate options to maximize asset depreciation to help offset my W-2 taxes owed? So we're in the same wheelhouse that we've kind of been most of today. High W-2, how can real estate help me reduce my overall taxable income? A lot of the same things come to mind.
It really is, but this allows us to pull it all together again. If you're going to do that, we have an option as far as, are we going to go for long-term rentals or short-term rentals? We want to look at that first. Going to be a lot easier to do the short-term rental typically because of a lot less time requirement. Over 100 hours, more than anybody else, or 500 hours of material participation. That usually is going to get us in the ballpark for our short-term rental. You brought up another great point earlier. You want to have that house somewhat nearby so that you're managing it. You don't want it across the country, a little more difficult, a little more challenging to prove that. It's not that we don't have clients that do that, but you want to really document, make sure you're showing any of this that you do, whether it's short-term or long-term, make sure we're documenting. So those are all thoughts I would have immediately. And just remember that if you don't meet the particular standard, material participation for short-term rental, real estate professional for a long-term rental, If we don't meet that requirement, it all becomes passive loss, which can only offset against other passive income. So we want to keep that in the back of mind because we aren't going to offset that W-2 unless we meet those standards. That long-term rental, we haven't hit that as much, but the real estate professional, Amanda went through the test earlier, over 50% of your work week has to be in a real estate trade or business that you materially participate in. And if we're a W-2 wage earner, it's real difficult. Oddly enough, the one case that we often point back to is a guy who did just that. He was a pilot on the riverboat. Use the same term pilot, but
I know that.
yeah,
Learn even non-tax things around here.
exactly. And he had bunches of rentals, and he had just great records and support from his work staff on the boat of how much time this gentleman spent on his rentals when they weren't on the river. And he was able to document that, even though he had maybe a 40-hour-a-week pilot job, he still was putting far more time into his rental real estate. But we wouldn't recommend that for everybody. It was a very difficult standard, and he just kind of lucked out, and hard work.
We see this, if you've got a normal 9-to-5, 40-hour-a-week job, it's really hard to hit real estate professional. But if you are married and your spouse works inside the home and doesn't get paid the type of labor that the IRS doesn't recognize but is often harder than other types, then your spouse can qualify as the real estate professional fairly easily. I mean, the 750 hours comes to just about 14 and a half a week in terms of material participation hours. So if you're married, if you also, I've seen it, firefighters, high W-2 sometimes, work those 3-4 shifts, so half the time they're not on call. Teachers, if you're not substituting or doing any sort of tutoring over the summer, you're working 9 months out of the year instead of 3 over the summer. My first real estate partner was a professional soccer player. They don't work very hard. Games are only 90 minutes. Practices are a few hours. So he had a lot of extra time. And instead of playing FIFA, he invested in real estate. So he met this standard. So real estate professional status, not impossible, but it does have to fit your situation. Short-term rental loophole, though, anyone can do that. I mean, you do need the desire because it is, if you've got a full-time job such that you're earning a high W-2, assuming you're working a lot of hours, doctors, lawyers, things like that, you do still have to put in the work, but there's no outside restrictions for a short-term rental loophole. Just materially participate. In terms of what are we looking to be true when picking real estate options, I mean, there isn't any parameter in terms of single-family home, multifamily home, condo, the type of property, mobile home, those types of things. Can you do short-term rental loophole with a timeshare? I guess it would be hard. You usually don't have a timeshare for the whole year.
Yeah, I'd stay away from the timeshares. Those bring up a lot of other problems, namely, if you ever want to get rid of it. But there's a lot of issues with there. And it actually depends on the title, how your ownership is on that. So I would stay away from that.
But the type of property, not really relevant. If you are doing short-term rental, I mean, most people are thinking vacation location type of places, but plenty of people make pretty decent real estate portfolios with non-vacation area short-term rentals, things close to hospitals for people who have to come in and visit family. I mean, I personally, our family is a soccer family, and we are in Airbnbs almost every weekend for soccer tournaments. So I'm just kind of looking at an area that can sustain that type of rental activity. Absolutely. But the asset itself.
Common problems that we have run into, just remember when you get that building that, again, the land, not depreciable, so you want to factor that in when you're looking at the price of it. Some places the value of the land's far more than the structure itself, so keep that in mind. Again, the distance is another factor. Even under the rep status long-term rental, you also have to materially participate in the management of your properties, so that would almost necessitates having that property a little bit closer, at least that, one or two of them.
Very true, very true. Okay, if I experienced a loss from a flood that was declared a natural disaster in 2024, how do I take that credit on my taxes? Well, first, it's not a credit, it's a deduction.
Right. Yeah, we want to be careful because credits really are, tax credits are a direct dollar-for-dollar reduction in your tax liability, so it's not a credit. It is an expense deduction, though potentially. How do we do it? Well,
There's
first of
a
all,
difference between personal and business. So what do you want to do first?
yeah, let's do personal.
Personal. I got you. You can keep going.
So on our personal, number one, we have to have a federally declared disaster. That's the number one aspect we're going to run into. Now, a lot of the rest becomes somewhat similar to the business, but let's look at this. What you're going to do, it's going to be the lesser of. We have kind of an equation we have to use here. We're going to look at the adjusted basis. That's what we originally purchased the building for. In this case, personal, so it wasn't used for business. So maybe we made some additions, added to it, but we probably didn't do anything to really subtract until the natural disaster happened. But we're going to take the less of that versus the fair market value of the asset before the disaster hit, and minus the fair market value of the disaster after. And we take the lesser of those two components, that is the adjusted basis or the differential change here. And then, because it's personal, we have to subtract $500 from that. The remainder.
That's rude.
It is.
That's just rude.
But the remainder then becomes our deduction. And you do actually have to file a claim. That has been a problem. Sometimes people don't file a claim, so they're not allowed. Again, this is all in the personal aspect, personal asset.
Okay, business.
Business, very similar with a few twists to it. Number one, probably the number one starting point, no natural disaster needs to be declared. Significant difference, number one. But our overall calculation is pretty much going to be exactly what we just did above. Again, the lesser of the adjusted basis or the fair market value before or after, whichever's less. We don't have a $500 deduction here like the personal does. And that will get to our business, and we don't have to file a claim either. We can just put this on the return for that particular business. One little caveat, what if the asset is completely wiped out?
Total loss.
Total loss. On the business component here, we have just a slight different calculation. We're going to take the adjusted basis minus any salvage value, what's left. You know, if there's just a bunch of wood laying around, well, if we sell off the wood, what's that worth? Less any insurance proceeds.
I'm running out of room.
And that's going to be our deduction.
Okay. Adjusted basis
Minus
insurance
minus salvage value.
minus salvage.
And in the above too, if you have insurance, you would subtract that as well from
Up here?
from the overall loss with the $500.
Minus insurance.
We always take into account.
Can't get a windfall, as they call
No,
it. Can't
yeah.
take the deduction and the insurance.
Right.
So we're going to lessen our deduction because we obviously still want to take that insurance. Ooh. Are we good?
Yeah, we're good.
Okay, jump to the next one. All right. How do you depreciate remodel costs for an income property, so a rental property? So in this example, purchased the property 10 years ago for $100K and then began depreciating it. And so this year, they put $30K into a remodel, floors, paint, kitchen cabinets, appliances. So first of all, what happens to that $100K if we haven't fully depreciated it? Do we still just keep depreciating it straight line?
That's exactly what we do. So let's just take the standard run-of-the-mill 27.5 long-term rental depreciation life. So you take that 100,000 divided by 27.5, just a little bit under what, maybe around 22,000 a year or something like that. They did for 10 years. That's slowly being depreciated against that $100,000 of purchase. Remember, land not being a factor here. Then all of a sudden we went out and bought these other assets for $30,000. We don't just kind of throw that on to everything else here onto the pile. We look at those as separate assets. Typically, the floors, paint, kitchen, cabinets, appliances, they all have their own different life, depreciation life. So floors often 5. Kitchen cabinets 5 or 7 typically. The paint usually is just kind of an expense, unless it's part of an overall renovation, which it kind of sounds like it might be here. So we would add that amongst these costs in order to be capitalized and depreciated. But the big point here is that we don't just add $30,000 onto our $100,000. We're going to track those separately on the return. Our floor amount to be depreciated, the kitchen cabinets and the appliances. There we might be able to get away, if they're under $2,500, we could probably get away with the de minimis selection, which says if that appliance is under $2,500, Amanda is out renovating her rental, she gets a new washer and dryer set, it's under $2,500, she can go ahead and immediately expense that. Then she also goes out and gets a refrigerator. It separately is under $2,500. She
I
can
hope so.
do the same thing, right? Unless it's a really great fridge. But
Talks to you.
Right?
I don't want those. When the robots take over, we don't
Right,
want those
no.
expensive
No, don't
fridges in our house.
I'll use the fridge all day long.
You get to deduct that immediately instead of depreciating, which is essentially taking the deduction over time. So we're going to have multiple depreciation schedules going on. Now, in order to separate out the floors, the paint, the kitchen cabinets, the appliances into these 5, 7, 15-year property, can I just do that on my own, or do I need to do a cost segregation study?
I would suggest a cost seg,
Yeah.
because if the
gets
dollar
complicated.
if the dollar amount gets up there, and it may be beneficial to have done it overall with the original 100. We just don't know, but it'd be worth looking at, and seeing it. Now, a little of a sidestep here. What if all that was going on here is we were just fixing the floors or just doing the cabinets? We could fall back in underneath that $2,500 de minimis election, and she can go ahead and expense that just by itself. The cabinets, and that's all she did. It was $1,200. She could go ahead and meet that standard there. But here we have that sense of an overall kind of renovation going on, a little bit bigger plan scheme. The IRS is kind of clear on that now we got to start depreciating that.
Yeah. Could you spread each of these things out over the course of the whole year and call them separate?
You could certainly make that argument. There we're arguing. You're trying to build a case one way or another.
If you want to argue with the IRS, then you go for it.
Yeah.
I don't want to.
I won't be.
Yeah. Oh, this is a long one. Okay. I'm interested in using the 280 Augusta Rule rental of my home for an upcoming seminar I'll be attending online. So let's stop there. What is 280A or the Augusta Rule? It's where you can rent out your home to actually any third party for up to 14 days. It's actually in the code, it says less than 15 days, which to us lay people means 14 days. And you receive that rental income completely tax-free. So I could rent my home to Elliot for 14 days, and when he pays me that, I don't have to report it on my taxes. There's nowhere to even report it, so it's tax-free income. So what we have been advising clients to do is combine that with the need to have meetings in your company. So a corporation needs to have a director or shareholder meeting at least once a year. An LLC doesn't require a meeting, but we do recommend you guys to have meetings at least quarterly, at minimum at least once a year. So you can, instead of renting out to a completely different third party, hey, let's rent to our own business. That's going to take income coming into our business, pay it to us, we put it into our pocket completely tax-free, and then it reduces the taxable income on our LLC. So that's essentially what we're talking about in terms of why we're doing 280A meetings online. So now this question gets into kind of the nitty-gritty of how to establish that rental rate. So am I allowed to use this strategy if I'm the only person attending? Can you have a one-person meeting?
Quick answer, yes.
All right, that is a quick answer. Also, I reviewed, so we have a 280A kit for our Platinum clients. You can go into the Platinum portal, you can download this 280A kit. It walks you through step-by-step how to do that. Number one thing you're gonna wanna do is get quotes for a similar space from hotels, work-life spaces, things like that. So you're typically getting a quote for a conference room. This submitter makes a good point. If you call a hotel and say, hey, can I get a quote for one person to be in a conference room, they likely would just laugh at you. Unfortunately, different hotels will have different types of rates. It may be per person. It may be a food and beverage minimum, F&B it's called. So it's a little tricky to do that if it's one person. I would take the smallest space that they have, the smallest quote. There's also a lot of online options, quote generators. You can Google conference room quote generator, plug in your info, just get that without having to individually call or email any hotels. What have you seen people do with less people?
Yeah, and so along that, again, the quick answer is yes, you certainly can have a meeting with one person. There's no question about that. However, we do strongly recommend that you do have others. Maybe if you're watching this seminar online, have other people come over that are like-minded, that are maybe investment. Maybe you have family that's working for some of your entities or something like that. So while, yes, you can have one person, we really recommend having someone else over. A lot of these meetings, too, you watch the online seminar, maybe it's not all day long. have someone come over. You have a friend, a family member, a colleague who's into marketing. They have them come over and answer questions that you might have about marketing or bookkeeping or what have you, whatever it be. You have that attendance. So when we go out and we get these quotes, you can feel free in saying, hey, I need something for about 5 to 10 people. That's what I'm looking for, a small conference room. And remember, you only have to do the quotes once a year, get 2 or 3 for a year. So you don't know that every meeting is going to have a single person attending.
Yeah.
So feel free to go out and get a quote for 5 to 10 people, because you very well might have that going on the rest of the year.
Yeah, and it doesn't need to be a company meeting. It can be a networking event. It
Yes.
can be a mixer. It can be anything. Different from maybe using your home for a home office, it doesn't have to be a space dedicated to that meeting use for the whole year. So a home office, administrative office that you're deducting, that does need to be exclusively used for that space. So you couldn't use like your dining room table or your kitchen counter as your home office and take a deduction throughout the year because you're eating dinner there, you're eating breakfast there. But for this 280A strategy, you can use your living room, your dining room, a whole different room that you use separately for something else throughout the year, because we are just physically renting it for that 1 day or 14 days, ideally throughout the year.
And I completely agree with Amanda on the various uses of it. I would be a little cautious if we do too much of the entertaining, because entertainment is not not a deduction. The IRS does hit on that. I won't go into detail in the case of that, but I had a boat where it completely got wiped out as a deduction after just one use of someone entertaining on that boat. Mm-hmm. So we don't maybe want to do too much on the entertainment, but that's not really what she was saying. She was doing more of a marketing type thing. So just be careful on that, but absolutely there's a lot of ways you can use that.
Yeah. I had a client come into our Platinum Knowledge Room and say, he's doing this 280A strategy. He's like, if I take my whole list of clients and invite everyone, over 300 people, do I get a quote for 300 people?
I would.
It depends, right?
If that's going to be the food and beverage part of it, I would say
yeah,
so,
it depends. If you have 300 people that you could invite to a wedding and you're not sure if they all come, you still need a space for 300 people. Now, in this particular case, the client's listserv of people were not all local. So if we're inviting 300 people that are actually in a different country, they're probably not coming to your meeting. So you still want to make it reasonable of who potentially could show up, not because they think your party is going to be good or your meeting's going to be good, but that are like physically close enough that it would account for that. So and then what in terms of a quote, let's say I got a quote for 500 a day, we got a quote for 1,000 a day, and we got a quote for a really nice place with gold-plated furniture for 10,000 a day. Which can we use? What is a reasonable quote?
A couple different factors here. I mean, you could add them all up, divide by 3, get an average. You could look at it from the aspect of how profitable is the business, because if you only made $100 a profit, $10,000, no company's going to go out and pay $10,000 for a meeting room.
That's fair. That's fair. But this is a reasonable quote. You went out and you got it on the open market, so you could use 10,000.
You still have the argument, and here we would start making arguments.
Yeah, we don't necessarily want to have $140,000 meeting expense on your business tax return when your business only made $152,000, right? That's going to raise some red flags with the IRS. So we still want to make it reasonable.
Absolutely.
All right. I think that's our last one, Elliot.
It is.
It is. So if you have not subscribed to Toby's YouTube channel, you're on it if you're on YouTube. We do Tax Tuesday every other Tuesday live. You can get notified if you smash that subscribe button. Also, if you're interested in the legal and the asset protection side, these two things are very closely connected, especially when we're talking about real estate investing, stock trading, things like building wealth. You can subscribe to Clint Kuhn's YouTube channel. Those are our 2 founding partners. They taught us everything we know.
Absolutely.
Yeah. Well, We do a lot of reading.
Right, yeah.
We do a lot of our own research. Again, join us for a full day of tax and asset protection Saturday, April 26th, starting at 9 a.m. Pacific. And then again on Saturday, May 3rd. We run those most Saturdays out of the year. So if you can't make those two, register now. We'll send you some emails for the next one coming up. And we also have our 3-day live event. These are actually super fun. I know your idea of Vegas when you were maybe in your 20s was not hanging out with a bunch of lawyers and CPAs in Vegas, but they're actually really fun. It's great to see clients who have been clients for years. They come in. It's additionally a great networking opportunity.
Absolutely.
Got a lot of deals that get done in those back rooms. Yeah. And then if you'd like to become an Anderson client, click this QR code and schedule your free strategy session. It's 45 minutes with a business advisor or a senior strategist. We'll go over your assets, your concerns, your goals, and we'll put together a customized structure for you. Oh, here's the QR code for our live event. Again, you can also find all this information on AndersonAdvisors.com. Finally, if you've got any questions, we did a lot short-term rental. We did a lot of real estate. We usually do a lot of real estate. So if you didn't get your question answered, you can hit us up at taxtuesday@andersonadvisors.com. And if you say something really nice about Elliot, he's probably going to pick your question.
That usually doesn't happen.
Oh, come on, guys. Give him some love.
And speaking of love, just thanks out to our team. You know,
Oh, yes.
160 plus questions.
Just in the Zoom. That's not even counting what Troy's doing on the YouTube channel.
Right? Yeah, we got
chat.
Jennifer G out there, Arash, Dutch, George, Jared, Jeffrey, Marie, Rachel, Ross, Tanya, Troy carrying the day. And thank you all.
Yeah.
And we got Kenny, we got
Kenny and Matt in our studio. Thank you, Matt, for saving my life here with this water.
Because Elliot wasn't moving.
Because Elliot was going to leave me to die on the side of the road. But that's it for us. Join us next Tuesday. It was great to talk to you guys. Have a great week.